Okay. Hello, everybody. It's Andrew Wall here, managing partner at CPA4IT. Um, and we're going to kick off in just one more minute here, give everyone a chance to log in. Um, Title for today's session is Maximizing the Benefits of a Professional Real Estate Corporation, a personal real estate corporation. So hopefully this will be a great session. I'm really excited. As I said, we'll give it just a few more minutes for everyone else to log in. And while we're waiting, I might do a little bit of housekeeping. If you are watching this live or even after the fact and would like to receive a copy of the slide deck or our PREC guide and or both, you can text PREC to 647-496-6379, where my AI agent will be happy to share that information with you. And of course, if you have questions as we go throughout this session, I would encourage you to use the Q&A. That's going to be the preferred method of asking and answering questions. At the end of the session, I will also double check the chat to see if I haven't missed anything, and I will go through the chat. And of course, if anyone wants to actually raise their hand and be given the opportunity to unmute and ask their question in person, please use the raise your hand session. So with that, I think we're probably ready to kick off. It is right on time now. So again, today's session is really about personal real estate corporations. But the bottom line of what I'm here to do is help you understand how I can save you time and money with a personal real estate corporation. To do that, I'm going to start with a little bit of background about ourselves. And I'm going to give you guys some tools to save you time. And those tools we'll give to you whether you choose to work with us or not, or at least some of them we will. And the others will give you a discount should you choose to use them. Then I'm going to get into the meat of this session, which is really going to be the tips to save you money with a personal real estate corporation. And then finally, we'll close off with some strategies on how to minimize risk. So a little bit of background about who we are and who I am. My name is Andrew Wall, as I said earlier, and I'm the managing partner of CPA4IT. We're an accounting firm specializing in service-based businesses just like yourselves, and we've been doing that since 1984. I know the PRECs are relatively new here in Ontario, but we have been specializing in IT consultants who are very, very similar to personal real estate corporations since 1984. And as a result, we have lots of information, tools, tips, tricks on how to maximize the benefits of owner-managed service-based businesses just like yours. We have been recognized for the work that we've done in leading technology as one of the top 50 cloud accountants in North America. Every year the competition was run. We've also been recognized this year in 2022 as one of the top 100 pro advisors worldwide. And in fact, we're hoping to win top 10 in Florida as I'm heading down there next week. We've also been recognized as an elite QuickBooks Pro advisor, which gives us some access to some incredible pricing if you are interested in using QuickBooks. And as I mentioned before, we have been specializing in service-based businesses since 1984. I know I look a little young to have been around that long, but I was here shortly thereafter in 1999, but the firm was originally founded by my father, George Wall, and we are indeed a second-generation accounting firm and a family-owned and operated firm. We also do take systems and processes very seriously, and we are one of the few accounting firms that are ISO 9001 registered. For those of you not familiar, that just basically means we've got a system of processes that we follow for ourselves that are independently audited. Hi, Tao, thanks for saying hello, and hopefully everything is coming through in my audio. Just a quick check on our chat. Now, a little bit about why clients do ultimately choose to work with our firm. We do offer a free initial consultation. So if you're not sure whether PREC is right for you and this is the first session that you're having about it, come in and talk to one of our experts. They'll be happy to walk you through the pros and cons of a personal real estate corporation and figure out whether it is the right fit for you. We are a turnkey solution in that we do offer both the incorporation services as well as the corporate tax services, and we can help you through the entire life cycle of creating, operating and potentially dissolving your corporation down the road. We do also offer a couple of proprietary things that we do that make us unique, like our industry benchmarking analysis. So we can show you how you compare against the average and the median. This is an opportunity to identify opportunities where you're maybe below the average and missing out on potential deductions that everyone else is able to claim, or potentially at risk because you're above the average. And if we've red flagged you, there's the potential that CRA might have red flagged you as well. And so let's make sure that we've got the documentation in place so that if you are red flagged, we can at least make sure we've got the documentation to defend and win against a CRA audit should it come down the road. And speaking of audit, one of the things that we do offer all of our clients is our audit representation protection. This means that if you are ever audited for any of the work that we've prepared, if you have our audit representation protection, which anyone who's on a prepayment plan will get included in their package, we'll represent you up until the third and final stages of appeals, which is as far as we can go as your CPAs. And we will not charge you anything for any of the time that we spend in those appeals processes. And this is to make sure that you've got the comfort and peace of mind to know that you've got a knowledgeable representative there to argue your position and make sure we defend your rights as a small business owner, because all too often clients miss out on legitimate deductions that they are entitled to because they don't know how to operate or deal with CRA. And we've been doing this, like I said, since 1984. And it's we're fairly comfortable talking with CRA auditors and certainly not intimidated by them. And we like to do our best to make sure that we've got the documentation and the information to be able to put them in their place. So I'm not going to belabor the point about us too much. We are really here to talk a little bit about personal real estate corporations. And when you form PREC, you're creating a legal corporation that will receive the revenue from your real estate business and pay the expenses of your real estate business and will be a separate taxpayer. So this is a separate legal entity. And as a RICO registrant, you will need to be in full control of the PREC, which will refer to you as the controlling registrant. And so all the regulations call for a controlling shareholder of these personal real estate corporations. These personal real estate corporations are something that your governing body fought for because they bring significant benefit to you. So we really want to make sure that this is a tremendous opportunity that you're aware of all the benefits. We're going to do our best to walk through at least the top 10 benefits that you can use today with a personal real estate corporation. And we're going to be talking you through, like I said, some tools to save you time and some tips to save you money. And then we're going to close with some strategies to give you the comfort and peace of mind that you've got everything protected. So without further ado, let's jump into, oh, sorry, not quite there. A little bit more background information. I got one more slide there. So, I mean, if you're considering a PREC, there are a number of factors to consider when deciding to form a personal PREC. And it's strongly advised that you work for a professional that provides accounting services, that's knowledgeable in these structures to be able to provide you the tax strategies that are available specifically to realtors. However, we have developed a number of tools to make this process a little bit easier and to help you understand some of the at least financial benefits. So you'll find on our website, we do have a calculator to calculate the financial benefits of incorporating. Again, if you texted PREC to that number we mentioned before, which we will mention again later today, you'll get a link to this slide deck. And in this slide deck, this is actually a hyperlink to be able to find that calculator if you're trying to find it on our website. Of course, there's some link to our pricing on incorporation if you are considering incorporation. Our costs for incorporation are very, very, very competitive. So if you're looking at doing that, we're probably cheaper and just as capable of preparing that as your local lawyer. And all too often, we do see clients go ahead and try and do this on their own, which you can do. But all too often, we see that done incorrectly, and then we have to file articles of amendment, which cost you just as much. So if you're considering forming a PREC, come in, check out our calculator, see what's right for you. And if you have not set up this corporation yet, feel free to check out the pricing on our incorporation packages. Now, finally, without further ado, let's jump into how we're going to save you time. And you're going to see I've got some great quotes in here as we go from section to section. I'm not going to read them. Feel free to enjoy them. So the first thing I wanted to talk to you about is one of my favorite tools for saving you time. And this is a tool formerly known as Receipt Bank, now referred to as Dext. Again, if you've texted PREC to that number above, you're going to get access to at least 1 year free subscription to this software. This software is normally about $20 a month, but we will provide you for 1 year license for free. And if you want to keep it beyond that, you can pay the retail pricing. Or of course, if you choose to become a client of ours, we provide this software free to all of our clients as long as they are a client of ours. And I'm sure you're wondering, well, what is this software and why do I need it and why do I want it? And this is what I consider the most magical software in the world. And that's because it helps me win audits. Why does it help me win audits? Because the number one reason I can't win an audit is because I don't have the documentation to defend a deduction that's been claimed by one of my clients. And one of the first things that I need to be able to win an audit is I need the actual receipt. And what some of you may know is that most receipts these days are printed on thermal paper, which means if that paper sits on a dashboard in your car or anywhere warm, that paper will fade and be completely illegible by the time you go through an audit. In addition, that assumes that you've actually kept the receipt and hasn't been crumpled up or lost or eaten by your dog or whatever the case might be, or lost or misplaced. So the first thing that this piece of technology is going to do is it's going to allow you to take a picture with your mobile phone of your receipts as you pay for them, so that this information can be documented before you even receive your coffee. And what it's going to do is it's not only going to snap a picture, which is never going to fade, which is never going to get lost, which is not going to take up any storage room in your basement, but it's also going to OCR that transaction. Sorry about that, the joys of working from home. It's also going to OCR this transaction, which means optical character recognition, which means convert a picture to text. And that text is then searchable. So we can search by date, by vendor, by amount, all sorts of useful information, so that if you're ever going through an audit, the auditor says, hey, I want to see the top 10 receipts for this category, you can find them and find them by date quite easily. So like I said, this is a magical piece of software. We absolutely love it. And because it's OCRing and taking all this information, that can eliminate a lot of the drudgery in bookkeeping by either allowing you to download a spreadsheet of all the transactions, or by linking this to a general ledger software. And the next tool that we're going to recommend that you do is leverage one of the general ledger software tools like QuickBooks Online or Xero. And we are big fans of QuickBooks Online. And in fact, as I mentioned, we're an Elite Pro Advisor, which means we get special discounts and we can give you the best price that you can possibly get on QuickBooks Online. And we just flow through our savings out to our clients directly. The reason that we love QuickBooks Online is that, yes, it can be connected to Dext/Receipt Bank so that those transactions automatically flow in. But even if you're not using Dext or Receipt Bank, you can get a huge amount of time savings by leveraging this technology, because you can connect your bank account and your credit card where 95% of most people's transactions are coming through. And those can be automatically pulled or fetched every single month, so that you don't have to key a single transaction from your bank statement or your credit card statement. And then you can leverage artificial intelligence that is built in or baked into the software to automatically process these transactions. And there's a number of things that you can do. There's the ability to match. So this will find a transaction that's already been created. Like, for example, if you were using Dext and the transaction was flowing through automatically, there'll be a match feature and the software will just tell you, hey, I found a match. This is a transaction within the same date, within the same amount, and we can correlate those two items together and match them. The other thing that you can do is you can create these user-defined rules, or what we call bank rules. So you can say, hey, you know what, I'm not going to connect this into Dext or Receipt Bank. I'll still use Dext as my sort of documentation tool, but I'm going to do all my coding from what we call cash coding, or transactional type of coding from your bank statement and credit card. And you can create rules that say, hey, every time I go to Starbucks, If it's under $10, I'm going to call that business promotion because that's just meals and entertainment for myself, and that's only 50% deductible. But if it's over $10 or $20 or whatever your threshold is, I want that to go to advertising because that's a gift card that I'm donating. You can create that kind of granular level of rules. You can apply different rules to one card than you have to another card or bank account. And so when this comes in, you can choose, do you want that rule to process those transactions automatically? For example, I have a rule for ESSO that I process automatically because I know every time I go to ESSO, it is always going to be fuel. So I don't even need to look at that transaction. It's just going to process it for me without me even needing to think about it. And one of the things, if you are transitioning to opening up a PREC, the goal and the objective is let's make this as simple and as easy as possible. I mean, if you were a sole prop before, you had to use something to track these receipts, but we can make that process painless for you. And we think QuickBooks goes a long way from making that process as painless as possible. And in addition to these rules that we've talked about in the matching, there is the baked in artificial intelligence, which is going to process the account transaction for you based on how you've either processed transactions in the past or how other users within the entire 2 million users that we have in QuickBooks Canada have processed transactions from ESSO. So it's going to make recommendations. Now, with those recommendations or those rules that you haven't set to automatically process, you're going to be able to see those transactions right on your bank statement, and you can just simply accept them. And you can even highlight them all at once and accept all of those transactions all in one quick swoop, and bam, you're done. So huge time-saving piece of technology that we are big advocates for. But now I know you guys are dying for the big question: how are we actually going to save you money and drive financial results using your personal real estate corporation? So the first strategy that we want you to do is to maximize your deductions, because every dollar of deductible business expense is a dollar that you pay zero tax on. Now, of course, we want to make sure that you're not doing anything fraudulent. You're only claiming the things you're legitimately entitled to. But the reality is most people miss out on deductions, not because they're not being fraudulent or not being aggressive. It's just because of a couple of key factors. One, there's a lack of knowledge on what they can and can't deduct. We've got entire videos, sessions just like this one you can go back and find on our YouTube channel or on our Facebook page, where you can see we've done an entire hour-long session on what types of things you can deduct as a small business owner. We also have a guide that we provide to every one of our clients on our standard chart of accounts and what types of expenses you can expect. But the big thing here I want you to recognize is that when it comes to what you can deduct in your business, there are three major criteria. First, it can't be specifically disallowed by the Income Tax Act, and that's a pretty important one. But there's not that many things that are. Those are things like golf green fees, club memberships, life insurance, your primary home telephone line. Outside of those four things that we've just mentioned and a few others that are not notable, you really only have two other criteria, and that's that the expense is reasonable and that it helps your business earn income in the future. Both of those things are subjective and open to interpretation, and we believe it's you, the business owner, who can interpret those most accurately. And we're here to fight for your rights and help you understand what you can deduct, as opposed to telling you what you can't deduct. So if you have any questions about, knowledge about what you can deduct, again, feel free to reach out and connect with us. Now, the other reason that people miss out on deductions is because of poor record keeping. They've lost the receipt, or they just haven't kept track of it. So cash is the most offensive four-letter word that you can use in an accountant's vernacular. So please eliminate that from your vocabulary. Get in the habit of using debit cards and credit cards. I'm a huge fan of Amex because of all the point structures that you can do with those guys and all the amazing benefits that you can get on travel. And if you need a referral, we're happy to make a referral because we get some benefits and incentives for referring people, and you get some benefits for using our referral link. But you want to use that so you have the track. Now, the number one thing, if you're getting a corporate credit card, make sure you pay it off at the end of the month. I'm not encouraging anyone to carry a balance. That's just silly. But make sure you're using digital technology to keep track of all these transactions so you don't miss out on them. Because if you use cash and you don't take a picture of that receipt, odds are you're going to miss out on that deduction. And that's one of the second most common reason people miss out on deductions. And the third and final reason that people miss out on deductions is because of fear of dealing with Revenue Canada. They, like I said, are afraid of a CRA audit, so they'd rather leave money on the table than put at risk dealing with CRA. And we certainly can understand and appreciate, a rational, safe fear of CRA. But we also want to make sure that we give our clients what we call full option accounting, which means we're going to lay out the options from aggressive to conservative and allow you to make a decision where on that spectrum you fall. And that way you're making an informed decision and you're not making it on a fear of Revenue Canada. And of course, we'll back that up with our audit representation protection so that if we're standing in front of CRA, you've got us holding your hand and defending your rights as a small business owner. Now, the next step is really optimizing your tax planning. And this is where we get into those top 10 strategies I was telling you to leverage within a personal real estate corporation. And I'm really just going to touch on those here. But the first and most important benefit is the low corporate tax rate. And this is one of the big reasons that your governing body fought so hard for you to achieve the benefits of a personal real estate corporation. A corporation in Ontario pays only 12.2% as opposed to the highest personal tax rate of over 53%. That is a huge, huge savings. So the only way this works, though, is by actually leaving money inside your corporation and looking at your corporation as something that is going to create a legacy for you. One of our objectives here is to help our clients organize their finances, create wealth, and transform wealth into a legacy. We see your corporation as the tool to creating that legacy, and that means what your goal and your objective is to build up assets inside your corporation, invest those assets where they've been taxed at only 12.2%. So you've got 88 cents of every dollar you've earned to be able to invest and generate a return. And we want you to grow that nest egg such that you have a sufficient nest egg that you can live off the interest or the growth of that nest egg alone without ever needing to touch the principal. And that's how we create a legacy. But again, we got more information about that should you come to one of our other sessions about creating a legacy. The other advantage that you're going to get is the ability to use tax deferrals. This is absolutely critical to the real estate industry where, hey, there's a lot of these peaks and valleys. And so if we can defer taxes by either declaring a bonus down the road or pushing stuff from corporation to personal or personal to corporation, we get a lot of advantages to being able to help smooth tax. And again, we can also do that by using income splitting, which is splitting income between spouses and children and even parents and other family members. Now, the one thing to be aware of when it comes to income splitting is that a few years ago, there were some new rules put in place called TOSI, or tax on split income, which really take away a lot of the benefits that used to exist. You can thank the Liberals for that. And there used to be a lot of benefits for small business owners. And the Liberals came in saying that this was an attempt to take away a benefit to the top 1%. I can tell you, having specialized in small businesses, the people that this hurt was the middle class, and it was used largely by people as an income splitting tool when children were in university, which is a very expensive time, as you can imagine. And we used to do dividends out to the children where we could do a dividend and there was no expectation of work involved, so we could give a dividend for any amount. And it became very tax effective to be able to get money out to the children to be able to pay for their university courses. Unfortunately, those TOSI rules came in and basically said, can't really do dividend income splitting unless the people are actively involved in the business and or the business owner is over the age of 65. There are a few exceptions to TOSI, but for the most part, income splitting through the use of dividends is not really viable anymore thanks to these new rules. However, income splitting through the use of salary is still very much applicable today. The only thing is that this is subject to a reasonableness test. So we have to be able to say that the salary that we're paying your spouse or your children is reasonable for the work involved. But there's lots of things that we can get our family members involved in that we can justify a fairly high salary for. Social media assistance, websites, which these are things that children are probably better than we as adults are. And as well with spouses, just being your financial partner and your confidant and your business partner and coach, we can justify salaries in the neighborhood of $35,000 fairly easily. And we've been successful being able to do that kind of income splitting over the years without any issues using salaries, even with these new tax on split income rules. Now, the other thing that we talked a little bit about income smoothing and understanding what this is. And income smoothing is a bit of an umbrella term for various types of techniques and methods used by accountants. And that can be tax deferrals, it can be income splitting. But the objective here is to smooth income over as long a period as possible. And particularly in the real estate industry where we have these peaks and valleys, that ability to smooth income is huge. And that largely stems from the fact that in Canada, we have a progressive tax system, which means that we have these different tax margins or marginal tax brackets. And as you go up in these different tiers, the tax rate for that new tier goes up. Now, it's only a new tax rate for that new tier. But what that means is if you have, let's say, 2 years of $50,000 versus 1 year of $100,000 and zero, you'll pay more with 100 and zero versus 50 and 50, or even 75 and 25. So the more that we can smooth income and the longer periods that we can smooth that over, the lower the total tax that you will pay. And a corporation gives us the ability to do that because we have the ability to do bonuses. We have the ability to do home loans. We have the ability to do auto loans. We have lots of tax strategies available inside of a corporation that were not available to you as a sole proprietor. And so this is one of the big advantages brought to you over sole proprietorship. And that's really going to help you to smooth out those peaks and valleys within the industry that you're in. As I mentioned before, we've also got the ability to leverage home and auto loans. This is the ability to take money out of your corporation without having to take it into income personally. Now, there's a couple different types of loans that we have available. There are shareholder loans and there are employee loans. A shareholder loan basically can be taken for any reason you want, but it must be repaid within 1 year, and then you can't take it in the following year. So you can do every other year type of scenario. And it can be for any amount and for any reason what you want. And it's also often referred to as a net debit balance in the director's advances. But you can do that, like I said, anytime you want. But it's only good for 1 year, which doesn't really help you, and it can't be done in the subsequent year. If you want a longer term loan from your corporation, you're going to be looking at either a home or an auto loan. Now, home loans and auto loans are not loans to the director, they are loans to employees. So they're not shareholder loans, they're employee loans. With that, that means we do have to calculate interest on these loans, which does become a taxable benefit to the employee. However, the cost of that interest, which is sort of left pocket, right pocket, because you're both the employee and the employer, is very, very small, because what you're talking about is you're talking about your tax rate, whatever your marginal tax rate is, on an interest. So it's a percentage of a percentage. So it becomes a basis point, very, very small cost for a very, very large advantage, which is basically to defer when we take money out of your corporation. And with a home loan, we can defer that over 25, 30 years, with a car, 5, maybe 7 years, anything comparable that we might find in the market. And there are prescribed interest rates by CRA as far as how much the interest rate has to go for that calculation on the taxable benefit. We will handle all that. We will get all the documentation in place to make sure that you're able to leverage these. But it's important to know that you can only do these loans in the years in which you purchase a car or purchase a home. And you can't do that for renovations or updates or things like that. So keep those things in mind, but they are great strategies for people looking to get access to funds inside their corporation without having to take that into personal income and pay tax on it. There are a number of other strategies for doing similar types of things with insurance. And in fact, insurance is a really great strategy for many different reasons. Right now, people are looking at them more and more because of some other income issues that we have on investment income. And insurance products can somewhat avoid some of those issues that we have, where if you have too much investment income, it can begin to erode your small business tax rate. Because I told you earlier, you only pay 12.2%. Well, that's true, but it's only on your operating income, not on any investment income. Investment income is taxed at a different rate, and in fact, anything that's not eligible for the small business deduction, which means anything over $500,000, would be taxed at a different rate as well. And so what happens is that rate can be as high as 38%. And so if you have too much investment income, it begins to erode your income that can be taxed at 12.2% and moves it to 38%. So we don't like to do that. The insurance strategies are a good way to avoid that investment income, because it instead growth in your insurance product, which then ultimately comes out to you in through something special called the capital dividend account. And that capital dividend account is tax-free. And there's these really interesting tools right now, like something called the ICE maneuver, which allows you to, I'll give you the shorthand version of this, but you effectively go to your bank, you get a loan personally, based on the fact that you're going to purchase a life insurance policy inside your corporation. You take that money that you've received personally, you deposit it into your corporation, which means the corporation now owes you that same amount of money back. You purchase a life insurance policy, which is used as collateral for the loan that you've taken, and you instantly created, a debt from the company to you that you can withdraw your own money and use that for what have you. And the insurance product hopefully grows over time based on its, return. At the end of the life insurance policy, a benefit is paid out to the corporation. That flows through to the shareholders through a capital dividend account, tax-free. You pay off the bank loan with that money that you've received tax-free, which means you were able to get a big chunk of money out of your corporation completely tax-free. Now, these are very special and unique strategies. It's not that they are risk-free. I'm not trying to pretend they aren't. And they are complicated, but they are very, very sexy when it comes from a tax perspective. So if you're interested, again, reach out and talk to us. We can tell you all about these strategies. Other things you can look at are personal pension plans. There's a personal pension plan and an individual pension plan. The IPP is the more modern of the two, and the IPP basically allows you to create these pension plans that allow you to switch in between defined benefit and defined contribution, which basically just gives you more room for what you can put into your pension plan. And the big advantage of pension plans is they kind of work like an RRSP. It's the easiest way for most people to grasp and understand them. They're very different, but that's fundamentally how they work. You're allowed to put money into the pension. It becomes a deduction, so it reduces the taxable income of the corporation. And then the employee, when he receives the pension, is taxed down there. So it's sort of a deferral strategy. But the nice thing about an IPP is it multiplies your RRSP room. So if you're up against limits on maximizing your RRSP contributions, a IPP or a PPP is a new tool to be able to basically get more room in a very similar type of benefit. Capital gains exemption. This is another benefit available to corporations. It's not available to sole proprietor. This is basically if you sell the shares of a qualifying Canadian business, you get a lifetime capital gains exemption. I'm not sure the exact amount. I think this webinar is out of date. I have the 2020 number, which is $883,384, but that's indexed to inflation. So for 2021, it was higher, and for 2022, it's even higher. So I got to update this slide. And what that basically means is that if you sell your business for more than $883,000, you won't have to pay the capital gains portion on 883 of that. So let's say if you sell it for 400, you basically aren't going to pay any tax whatsoever. If you sell it for 900, you're going to have to pay tax on that 17-ish thousand. But again, because it's capital gains, you only pay it on half. Really interesting thing, but the reality is most people don't often buy shares of corporations. This is touted as one of the big benefits. It is if you actually are able to use it, but a lot of people aren't usually end up able to use this because even if you do have a sellable business, which means that your business is more than just you, that the individual buying your business is willing to buy your shares rather than your assets. And it's more risky for a purchaser to purchase shares because when they purchase shares of a business, they take on all the legal responsibility that corporation ever had, which most people are usually pretty hesitant to do. But it is a benefit that you can get if you can convince a buyer to buy shares, not assets. Next, and I think last on the list, we have the concept of holding companies. So we talked about creating this legacy earlier. And usually once we reach a critical mass, we want to move the assets or separate the assets from the operating income. And we want to do that for a number of reasons. Asset protection is the primary one. If anyone were to ever come after your operating company, they wouldn't be able to go after the assets held in your operating company. It's a separate legal entity from your operating company. It does also allow us to move funds back and forth between the two companies and move them up tax-free to the holding company. And it also gives us some strategies and some things to avoid what I talked about earlier, but these new rules and regulations that minimize or can reduce the amount of small business deduction that you get for your business. We've got some tricks up our sleeve. In fact, we've almost always got a trick up our sleeve to help you reap the rewards of your small business. And with a holding company, there's a couple of things that we're going to get out of it. And like I said, one of them is that help us reduce the small business deduction limitation that comes from passive income, as well as to change the nature of the way your passive income is taxed. Because as I said earlier, passive or investment income is going to be taxed at a higher rate than active income that's coming from your primary business, from your primary real estate business. And so if it's all merged together, CRA is going to tell you that your expenses will reduce your active business income first, not your investment income. When we separate it out to a holding company, we make that decision of what expenses go into what company. And so the objective is to reduce the passive income first. And then if we've wiped out all of that, then we'll move our expenses, the remaining expenses, over to the operating income. And that just gives us some more tax advantages. Again, some loopholes up our sleeve to help you maximize the benefits of these new structures that are available to you as a real estate professional. Now, the last thing on our list was just to help you understand how to minimize some risk, because when you do have a corporation, there is some risk. And one of the things we want to do is to make sure we benchmark your numbers. As I said earlier, this is a proprietary tool that we use to show you how you compare against the average and the median in our database. This will pinpoint areas where you're below the average and likely missing out on deductions that you're legitimately entitled to. It's also going to identify areas where you're above the average and at risk for a potential red flag by CRA. And that allows us to determine if your deductions are different for valid reasons. And of course, to put the documentation in place to make sure that we can keep those deductions should they be valid. We also offer our audit representation protection. And this is something that we've been offering for a very long time. And we pride ourselves on being able to offer you this expert advice and the strategies to help you maximize those deductions, but more importantly, to stand behind those strategies and be able to make sure we not only tell you you can claim those deductions on your tax return, but that you can keep them. And I think these are some of the things that make us uniquely different. As I said, if you want to get copies of this slide deck or our personal real estate corporation guide, you can text PREC to 647-496-6379. And if you go ahead and give us your name and email address as well, we will also provide you a free copy of Dext or a receipt bank, as I mentioned earlier. So again, thank you everyone for joining this session. I'm going to open it up now to Q&A. So if anyone has any questions, please do feel free to pop them into the question and answer. And we'll give it a few minutes. And if there's no questions, we'll wrap here and thank everybody for their time. Okay. So this means one of two things. I can see people bouncing. I either did an amazing job and there's no questions, and I've answered everyone's questions beforehand, or I've just confused you even more. Hopefully I was able to answer your questions and give you guys some value. And again, thank you for taking your time out of your busy schedules to join me. Oh, I do see someone has raised their hand. Let me see how I figure out who that is. I can see, come on. Almost there, give me a second, sorry. Oh, there it is. Ali. Okay, I'm gonna allow you to talk, Ali. You can unmute yourself and you're free to talk. You have a question.
Yes. Hi. How are you doing today?
Sorry, can you repeat that one more time for me? I had my headphones on.
I'm saying how are you doing today? Thank you very much for the presentation.
No problem.
So I wanted to know, even after these law changes, the passive income would still be taxed at the highest rate?
So yes, so there's a difference between the income coming through from your real estate earnings as a real estate agent and any passive investment. So if you're investing in stocks or even if you're investing in real estate, but it's considered passive income, not active income, like if it's not like it's your real estate income as a realtor is considered active income because that's your primary role and responsibility, right? Like if you're flipping houses and that's not your primary job, it's probably going to be considered passive income and taxed at the higher rate. Now, if you're doing it full time, or there's some other strategies with, setting up management companies, there's always some strategies. And again, I'd encourage you to reach out and speak with one of our accountants to talk through your individual circumstances. But yes, real estate investment income is taxed differently. Now, one thing to note is that with investment income, I said passive, but to be honest, passive income can be broken down into a couple of different types of income. You've got interest income, you've got dividend income, and
Rental income.
You've got rental income, and you've also got capital gains. So these are all going to be taxed differently, depending upon the type of income that they are. And like I said, there are often strategies that we can use to minimize the income. So for example, let's say that you had rental income. We'd probably look at setting up a management company for that rental income. And we would make sure that we take your salary out of that management company as opposed to out of your PREC company, so that we get that income down to zero, right? So because we're not taking a salary out of your PREC, you're going to pay more tax on the PREC, but that's at a lower rate. So there are strategies and ways to minimize that, but we have to look at everyone's individual situation to figure out how to do that effectively. Does that make sense?
Yes. And sorry, one question just for clarification. What is the tax rate that is applied to rental income? Is it 53%?
No. Well, so 53% is the highest marginal tax rate personally, right? And so rental income will depend on whether, like, is that your primary source of business? Are you a landlord and that is all you do? So there are ways that could be considered active business income. But assuming that it's passive income, yeah, it's going to be taxed at the highest tax rate. Now, I say 38%, but it always gets more complicated than that. It's never quite as simple as me being able to give you an exact number because there is a federal tax abatement and there's a bunch of tax credits that you get back. So it's not actually going to be quite as high as 38%. It's probably going to be closer to about 30% when you get all the other tax credits in.
Okay, I understand. Thank you very much.
No problem. Thank you for having the courage to ask a question. I think that was the only question that we've got. And hopefully you guys found this session helpful. And with that, I think we're going to wrap. So thank you guys for joining us. And I hope you enjoy the PREC guide and the slide deck. Bye for now.